Be glad to.
So everyone's not here, but whatever. When do we ever have everyone in the calls? They'll have to watch the recordings, but I have two things to say, and then we'll jump in. The first thing is, Ravi, are you with us?
Yes, sir.
Hey, there he is. We got a fresh green face in the group today. So Ravi, what we usually like to do for our first timer jumping in with us is take this like 30 to 60 seconds, give us a brief background about yourself, and then tell us what you're hoping to get out of the mastermind.
Yeah, absolutely. I'm a real estate agent in New Jersey. Currently have 12 doors under my belt, combination of single family, Airbnb, and condos. Looking to grow my portfolio, but I figured I'd jump on the mastermind and get into multifamily world because I don't know anything about that. I could do condos and single families all day, but I want to learn more about the multifamily world. And I'm also in the military, so I'm phasing out of that. So I want to just focus on real estate full time now, and that's how I ended. I mean, I think I spoke with Josh like over a year ago, and I didn't do it at the time. I probably would have been somewhere else in the world today, but here I am.
What are you doing in the military, Robbie?
I do logistics.
Nice. What branch?
Logistics and Air Force.
Okay, nice, man. Very cool.
What Matt was in, of course.
Yeah. Good old days. Back when I was cool.
He's all lame now. No one wants to hang out with him anymore.
Nobody likes hanging out with me.
Well, cool, Robbie. Happy to have you.
Thank you.
There's a handful of people actually in the Jersey, Philadelphia, New York City area.
Okay. I'm right outside of Atlantic City.
Ethan's in New York. Dan, you're in New York.
Yep, northern New Jersey.
Oh, you're in northern New Jersey.
In New Jersey, New York, also.
I don't know anything about the geography up there.
John's repping Philly.
John, Philly, yeah, there we go.
Yeah, New York City here, so I'd love to connect.
Sweet.
Absolutely.
All right, last thing I wanted to say, this is probably the most exciting. No, I'm just kidding, but did want to give you guys an official date. So we have targeted the, let me make sure I don't put my foot in my mouth where I was telling everyone what the date is. So the 6th and the 7th of October will be the dates that we're going to do our first in-person event in either Mobile or Gulf Shores. They're all kind of one and the same, like kind of, it's like an hour away from each other. But once we pick an actual location to go to, we'll book it and of course give you guys more specifics. But those will be the official dates to put in the calendar, the 6th and the 7th, and those are of October. And it'll basically, what's that?
I feel like the 27th, that was the most voted date, no?
I think it was 50-50, but the three of us couldn't all do the 27th and 28th. We figured we'd do it a little earlier. And if you can't make it, that's fine. But as many people as can, as many of you that can actually go ahead and RSVP, if you think this is something that you can make, then that would be recommended, because we're trying to figure out how many people are going to come so we know how big of a venue to get, all that good stuff. So anyway, those are the dates. So the 5th, 6th and 7th will be the actual days of the conference, but then a lot of us will be getting there the night of the 5th so we can prep for the all-day conference on the 6th and the 7th. Sound
Yeah,
good?
guys, just to fill in the picture a little bit more for what we anticipate happening. I've been to a bunch of masterminds. I'm sure plenty of you guys have as well. And there's anything from the large, grandiose mastermind where we bring in Tony Robbins and everyone spends a couple grand, to like the smaller, more intimate, kind of what I would truly actually coin as a mastermind. The larger events, the whole concept of a mastermind is like we all collectively get our nuggets together and make each other better. I'm not trying to even pretend that Josh, Reggie, and I are the ones who are trying to teach you everything in this business. I think we're going to collectively learn together through the group. And so the goal for this one is going to be the more, we'll say the more intimate setting, right? And luckily, that's the whole benefit of this group is this is not a 12,000 member group. You know, we're talking, you know, double digits here as far as members. And so we like to keep it as personal as possible. One that I recently went to that I really enjoyed, we stayed at, they rented just a large beach house in Panama City Beach. And it was a super intimate affair where basically everyone came with things to offer. But it worked out really well. So we're thinking either something as intimate as like a beach house where we'll have enough bedrooms for some people to actually rent out if you want, or you can just stay in the local area, but we'll collectively work out of the beach house. And as far as the flow, the first day we're thinking, you know, more of a get to know you type of thing. We'll have a couple of lessons. We'll probably have some guest speakers come in. That way you guys can actually meet our attorney. You can actually meet you know, our mortgage broker, our insurance dude. Like you kind of get to start to meet some of these people or property managers more physically one-on-one. And then we'll have breakfast, lunch, and we'll probably go out for dinner that night. The next day we're thinking we'll probably go on site where we can walk one of our properties. So you can walk, you know, we're thinking probably our 34 unit that we have in downtown Mobile, because that is one of the first properties or one of our next properties we're going to dispose of. So we might as well show you it before we get rid of it, is the thought process there. And then we'll come back after the on-site visit. That'll be the first half of the day. And the second half of the day, we'll come back and we'll do some more, you know, lessons and or get together as far as the roundtable discussions that evening. And that'll be it. So 2 full days, arriving early the day before we begin, or arriving the day before we begin, and then probably departing either late night the second night or the following day. So hopefully that filled in a little bit more of a picture of what to expect, guys. I think it's gonna be a great event. Okay.
Yeah, and just keep in mind that if you can't make this one, it's not like it's a one-time thing. We're gonna be doing this biannually now. So if you can't make this one, then we'll hopefully you'll be able to make the one that we'll do in Q2.
Yeah, we're thinking Q2, Q4 is going to be the cadence we're trying to go for going forward. And then just, can you just let me share screen, Josh?
Mm-hmm.
Here's one of the rooms, just to give you an idea of one of the places we were looking at to potentially rent out. So we're thinking, you know, some nice big beach house on the beach in Gulf Shores where we can kind of rent it out and just have a good time, get to know each other and learn a lot. So should be fun. Excited for something like that. All right, are we jumping right into it then, Josh?
Yeah, this is going to be the next segment of our deep dive into advanced underwriting. So we've already covered, Robbie, I know you're just joining us, and there may be some people that haven't had the chance to see all of our deep detailed underwriting analysis. So if you missed anything, encourage you to go back and look at some of the previous ones we've done, because we're literally going in order. So we've been underwriting a 90 unit deal in Pensacola in real time, actually been communicating with and negotiating with the seller and going back and forth doing our underwriting. So you guys are literally getting to see it just like how we would be doing it. And so we basically have updated feedback, updated financials. Some things changed since the last time that we were together last Thursday talking about underwriting. So we're going to deep dive into that as well as some other great golden stuff. So Matt, Reggie, y'all can take it away.
Sweet. I guess I'll jump in. Reggie, you can color in as needed if we want to do it that way. So where we left you off last week, guys, we had effectively finished the underwriting for the 90 unit that we were analyzing in Pensacola. I will bring up the screen. Well, there's not much to share. I'll give you the backstory first before we get into the numbers. So the 90 unit, if you guys remember, at the end of the analysis, we determined that it didn't quite fit our min threshold. So for Josh, Reggie, and I, our min threshold is we want to see it hit the perpetuity model, meaning we have to be able to refinance 100% of our capital out, 100% of all of our investors' capital out, within the first 3 years. And we just couldn't make the numbers work given the price that we were basically told was the min price. So we went to the drawing board. Josh, Reggie, and I had another discussion after the mastermind. We talked for another good, I don't know, hour or two about the analysis and figuring out what could we change within the numbers to try to make this work. Now, I will say this is a common pitfall with some investors where you'll run the numbers conservatively, and that what you'll do, you'll talk yourself into a bad deal. I see it quite often, I'll be honest with you. And so I will right ahead and just kind of caution you with the whole kind of get there itis kind of mentality, right? Do anything possible to tweak the numbers to convince yourself that a bad deal is actually a good deal. And so that's one thing we cautioned ourselves as we were kind of tweaking numbers the whole time. We're like, hey, what about this? Could we justify this being any lower? Could we justify a higher income? And we couldn't quite get to the point where we were getting 100% financing in a comfortable position that we were willing to kind of accept with regard to the numbers. So we went back to the drawing board. We said, I know at this price, the only other lever that we can pull at this point is going to be the price. And so at this price, it just doesn't work. So we went back to the seller and we told him, we said, hey man, we really appreciate your willingness to work with us. We're not even officially under contract yet, but we had kind of had a verbal agreement based on this price, but not even LOI was signed at this point. He had as far as paperwork, he had sent us a contract filled out, but not signed by anyone. So it was essentially a pre-filled contract that he had sent to us saying, hey, I agree to these terms. So that's where we kind of sat. We went back and we said, hey, the only way to make this work is if we're at 5.5 million. So if you guys remember on this one, the original price that we were underwriting to was 6.3 million, 6.35 million. And after backing in the numbers and slowly backing up to where we needed to get 100% cash out on the refinance, it was 5.55 million is what we needed. So Reggie went back to the drawing board and told him, we really appreciate what you were doing for us, but in the end, we just can't make the numbers work. They're not meeting where we need for our company values and our company goals. And so we just can't accept, a 6.35 asking price. We said, well, we were willing to do a 5.5 though. And on top of that, though, we didn't try to just drop price without giving an explanation. So Reggie did share kind of the reasons behind the underwriting. Reggie was being the main point of contact for this one. And really the main reason that we shared with him was the fact that and I'll go to the underwriting now, just so we can talk, you guys can see some numbers, was the fact that we had recently been severely burned by insurance. And it was surprising. What we ended up doing was effectively educating the seller on what the status of the insurance was. So if you guys remember for this deal, originally, I think, Reggie, I think you underwrote it to 120,000 or so a year. Then I upped it to like 150,000 a year. Then after we were all done and talking, we were like, okay, 200,000 a year for insurance really is going to be where we need to be comfortable. And $200,000 a year divided by the 90 units, that's 200, that's 22 of the door. Let me see.
So yeah, what'd you get?
What's that now?
I'm sorry, my apologies. I thought I was on mute.
No, you're good. You're good. And so what we ended up underwriting to was this 22 per door, which was like a nice in between. We felt comfortable with at that point. And we educated the seller. And the funny thing was, when we went back to the seller and talked to him, he was completely unaware of the insurance situation. He's coming up on an insurance renewal. So his initial gut reaction was, hey guys, I don't think insurance should affect the value of the property, which kind of shows us that he really doesn't understand how these properties are valued. And at the same time, at the same breath, he effectively said, well, I should probably sell then before I have to renew my insurance, because that's going to really hurt on the expenses. We're like, yeah, that's why the prices dropped. And so, Reggie, I'll let you add in any color before we jump into the numbers. Anything else backstory wise you want to reveal there?
No, I mean, I think you hit a lot of the high points. The seller, I think he's a sophisticated businessman, but he's not a sophisticated multifamily operator. And so there was that helped us a bit. The broker that kind of helped put this deal together, I can't even remember how we connected, honestly, but he calls me ever so often. He'll bring me a deal. We'll talk, multifamily. So anyway, he's been great in this situation because he's been, he can kind of be the go-between. But no, it was an interesting one. But I'll toss it back to you, Matt.
Cool. Sounds good. So again, first lesson that I want to pass to you guys for this one is the whole concept of trying to put a square peg in a round hole, trying to make a bad deal work. I'll equate it to like a real life scenario. One day I was flying my F-15. We were going from We were going from Panama City Beach. We were flying to Las Vegas, and we were super excited because we're going to Vegas and we're going to party and it was going to be awesome. We're going to fly drop a lot of bombs in Vegas. So super excited. Like there was all, however many of us, there was 12 jets we were taking. And as I was about to take off, I was flying, I was in the front seat. As I was about to take off, I get some caution lights. I'm like, whatever. I don't care. I want to go to Vegas, right? The caution lights that I would normally stop and kind of like determine what's going on a little bit more, but they were just caution lights, nothing, or they were advisory lights, actually, meaning they weren't that serious. As I go to take off, all of a sudden I get a caution light that quickly turns into a warning light. And I still, even like having these lights pop up, which are serious indications in a fighter jet, I still had the mentality of like, maybe I can just work this on my way to Las Vegas. Maybe I can just do this. Yeah, I'll be fine, right? Because when I looked down at the indicator, it was just a hydraulic indicator. Like my engines were still fine. I was like, it's just hydraulics. It's fine. And so I literally had the thought process of intentionally trying to fly from Florida to Las Vegas with this concept of like, I just want to get there. I can make this work. I'll be fine. Luckily, I decided to stay because as I turned back to the airfield to try to work the issue, that hydraulic light quickly turned into an engine light, forcing me to shut down one of my engines. And I had to shut down and I had to land on the runway with multiple failures in the jet and no brakes either. So I had to take the cable to land the jet, which there's not many runways that can take an F-15 cable. Like not many runways in the US have the cable to even save me. And that's in the situation where I was. And so luckily I didn't have that kind of get there itis mentality. Luckily I didn't follow through with what I wanted to with my gut reaction. So obviously more of a life or death kind of story to kind of relate to it, but it's all the same mentality, guys. It's all that whole concept of trying to make a bad deal work. So there are situations though, where you can turn a bad deal into a good deal. And so where we stood with this one, the first big lever we would pull would be the price, right? And so we said, hey, here's the price we can make work. However, that didn't meet the partners' expectations. We told you already the partners have a price set in mind, and that was it. And so the reaction was, hey, we can't accept that. So what do you guys think we did to try to make this deal work? We've talked about the expenses, we've talked about the income, we've talked about price. What other lever do you think we could pull to try to make this deal work?
Seller financing.
Yeah, man, seller financing. One of the biggest reasons this deal doesn't work is the debt behind it. And so we could reduce our risk and our overhead as investors if we are able to get into a position where the seller is willing to carry the note with terms that make sense and can lead to profitable outcomes. So we propose that. And so that's where we stand right now. Reggie, did we get a response later this afternoon at all?
No, I talked to the broker again today. He said no word.
Okay. So I'll jump into the numbers now so you can see from the analyzer perspective where we stood. We've already talked to the seller. Reggie's talked to the seller directly, and we know that they're not willing to seller finance it outright. We know they're not trying because they have a certain number of partners in the deal that have to be paid off. Other partners in the deal are willing to engage in a note kind of scenario. So what we did, we said, okay, well, if you're willing to seller finance some of it, we know we have a lender that's willing to give us a 80% loan to value on this property. What if you, Mr. Seller, would give us a 40% seller financing note? And then effectively we would have 120% leveraged on this property. That would give us the ability to cover the closing cost, as well as our capital expenditures, as well as any sort of additional reserves or working capital we want to have in place. And so that's what we proposed. So it minimizes the risk to any investor. So we, Josh, Reggie, and I personally would be accepting a higher level of risk through higher leverage. And we're not risking anybody else's money or anybody else from a liability standpoint. Just the three of us would be personally accepting that risk. And so I'll jump into the numbers now. But before I jump into the numbers, any questions about the scenario or the setup from here, guys?
I have a quick question just on the seller financing. Is that set up the same way almost as a typical loan and the seller is essentially working as a bank for a part of it, or is this a different structure?
Yep. No, you're exactly right. So the way it would work here, I'll do this, share screen. We'll whiteboard this one. We'll go to Roar's Scratchpad here. Everyone loves to see this. All right. So if we go 6.35 million on the price for this one. And I'm going to just use rough round numbers for that 40% and 80%. So we'll say we want the seller to seller finance $2.2 million of that. That's what we're requesting. Now, remainder of that, this is going to be seller financed. And the remainder is going to be leveraged, not the remainder, but 80% of that is going to be financed by the by our lender. So 6.35 times 0.8, call that another 5 million just for easy math here. Roughly 5 million is going to be from our lender. So the way this works is at closing, the seller's going to get paid 5 million. However, the seller at closing is going to pay us 2.2 million from that 5 million. Does that make sense? So all in all, roughly, we're going to have around $7.7 million in leverage total. But the way the seller's able to pay us 2.2 million without paying out of cash, is he's going to pay out of the proceeds that we're going to pay through the sale.
Wouldn't that be 7.2?
Yeah, sorry, public math is always embarrassing. Ethan,
So in that situation, does the primary lender, do they know about or do they care about the 2.2 million that the seller is carrying?
it all comes down to the positions of the mortgage. That's what they care about.
Okay. So as long as they're first, they don't.
As long as these guys are first position mortgage, honestly, like most lenders shouldn't care, right? Now they care from a lender perspective from your DSCR ratio, right? Because it's going to affect your debt service coverage that you have to, understand from your underwriting. But from a risk scenario, they don't necessarily care from that. So this has to be a second position loan for this to work. The other way to do this would be the Morby method. If you guys remember, do you guys remember when we discussed the Morby method a few weeks ago when we talked about creative financing? So if you have a lender that doesn't accept this, so let's say you have a lender that says, hey man, sorry, no go. I'm not going to allow any second position liens on the mortgage at closing, on the property at closing. It's not allowed. What you could do is you could use transactional funding for this well, let's see here. I'm just gonna go over the quick Morby method if we were to do that on this one. So $6.35 million on the purchase price. Now, if we wanted to close with 80% LTV, that was roughly 5 million from the lender. So we would need 1.35 million plus closing cost is what we need, right? That's our requirement to close. Now, what we could do, we could get that from a transactional lender, close from there, but at closing, outside of like the actual transaction, we could get the seller to sign us a promissory note for 2.2 million. And so from that 2.2 million right at closing, we would pay off this 1.35 million and we'd be left with the remainder. But it's the way of getting around it to where the lender, if the lender doesn't approve it, you could do that. You could effectively, what we would do, this would be a promissory note signed at closing, but we wouldn't actually attach it as a second position until about 30 to 60 days later. At that point, it would be a second position mortgage, but it's a delayed mortgage intentionally to not highlight it to the lender so we can actually still go through the transaction. So effectively, you buy it conventionally, knowing you actually signed behind the scenes this other promissory note at closing. That's the other way you could engage it. Yeah.
Hey, just two questions on that. So first of all, when you say the 1.35 million is transactional lender, essentially that would be 100% financing. So is it like a equity fund or something, basically?
Yeah. So I say transactional lender. Really, what this would be some sort of, you need to come up with cash to close this deal. You could get a transactional lender. You're right. Maybe the transactional lender is not the right term because a transactional lender is going to want to be like attached to the property. Really, what you need to do, you need to come up with cash in whatever way possible. Even if you raise it or whatever you do, you need to come up with this cash to close this conventionally. I'm sure there's transactional lenders out there that will allow you to do this, assuming everything's in escrow, they'll do it. What they'll typically charge is about 2%, 2 points to hold their money for 24 hours. So these guys would make whatever that is, 2% for 24-hour period. It's a pretty good payday for them with really minimal risk.
And then, so the fact that there's a 2.2 million promissory note, that means is that for CapEx? Because the purchase price is only 6.35, so all this adds up to 7 point something. So is that because we're going to do CapEx essentially?
Yep, you have closing costs, right? Closing costs, you have CapEx, and then you have working capital / reserves.
Yeah. Okay.
So the goal would be to have $0 come from us as investors. That's the goal. We make the deal come with all the money.
So the
What were
lender
the
gets,
terms
yeah.
of the- What were the terms of the seller financing?
Yeah, we'll go over all that now. I should try to build up a picture. We'll jump into the numbers right now, though. All right. Any other
So,
questions with the setup, guys? Go to Ethan.
Yeah, Matt, with that structure, does that mean you don't need investors if you're going to put $0 down and you're just going to
Yeah.
buy it outright with you guys?
Yeah, exactly. So there's no pref to be paid at this point, right? So that's one additional overhead not to be concerned with. Now that pref that we normally pay investors is effectively being swapped out with interest rate to the lender now that we're 100% financed. Do you know what I mean? So there is still, it's not like we're saving an expense, but I'm willing to take more of a risk personally, not with my investors' money in a scenario like this. Does that make sense? The more leverage you have in a deal, really what you're accepting is more risk in a deal. Leverage equals risk. So
from what you're saying, it's not actually the perpetuity model, right?
This one wouldn't, well, perpetuity model really only applies when you have investors.
There's no refi. Yeah, there's no capital in anyway.
Correct. Yeah.
So you guys could hold this for 5 years even.
Yeah, I mean, the goal would be to refinance out. So, I mean, we'll talk to the numbers here in a second, but yeah, the big picture concept here is we still want to adhere to a traditional flow and get into some nice long-term low interest debt. So then we can just enjoy perpetuity cash flow. That is our goal, is perpetuity cash flow in a stabilized asset that we check in, periodically with the property manager and everything's good. Like that is our goal, to attain as many assets like that as possible. And this is one way to potentially achieve that. Does that clear up the questions and the big picture where we stand? Any other questions? Okay, cool. Let's jump into it. Reggie, anything else to fill in before I jump into the numbers, man?
No, I think we hit all the hot stuff.
Okay. Let's see here. All right, so I'll do kind of what we did last week, and I'm going to show you what the standard flow for us, right? Josh typically is the initial kind of filter, then it goes to Reggie, then it goes to me. Where we stand now, since we're kind of regurgitating data, we wanted to reconfigure the analyzer to reflect that what we just discussed, the scenario we just discussed. And so this is what Reggie had sent me. And I'll show you I'll walk you through my kind of review of it all. So the first thing, some of this I'm going to reference from data from last week. So if you guys weren't here from last week, I apologize, but this will make sense as you watch the entire video flow. If you guys remember from last week, one of the big assumptions we were getting is understanding, or I guess it was 2 weeks ago, when we were understanding income analysis. And where I landed, where I was most comfortable, was actually closer to $1,200 a door. And so that's the first thing I changed. I said, okay, let's just change these to where they need to be to average out $1,200 a door. And if you guys have any big picture questions on that, I'm happy to answer them. Otherwise, I'll just say reference our video from a couple weeks ago. So there's roughly $1,200 a door is what I did to update the income, just to make sure we're on a conservative path to where we want to be. Didn't mess with the price because that was totally fine. Everything else is relatively normal. I'm not going to go line by line here, but I'll kind of go with the things that stuck out to me that I wanted to change. Now, the biggest thing you guys will probably notice if you're comparing from previous weeks is the fact that our CapEx and repairs, reserves, working capital, our overall kind of slush fund, if you will, was reduced from our previous analyzer. So we went from 1.2 million down to 600,000. So that was the first thing I highlighted, and we'll jump into that here in a second, because I know one of the questions we've been getting quite a bit from some of you guys in the group is, how do you estimate repairs and reserve or capital expenditures, like a project from a project management standpoint? So we'll jump into this in a second, but that was the first thing that highlighted me as the conservative guy. I want to make sure we have enough cash, and I don't want to have to pay any more damn money into my apartment complexes to keep afloat. So that's the goal. All right. So from there, I looked here, total member capital needed, 2 million. Now the analyzer isn't necessarily optimized for the scenario that we're doing. So we kind of need to pull the numbers a little bit out of the hat. But that's just one thing I noted here. Okay, roughly this is saying if we leverage at 80% here with a $5 million loan, we need $2 million cash to close. That's including the reserves, including the closing costs, all that fun stuff. So that's roughly the number we were looking at. All right. So that was the first thing that highlighted to me. Everything else was pretty normal from last week as far as income we talked about, the vacancy, economic and physical vacancy, which we discussed. It was nice to see that Reggie had actually increased the insurance from 180,000 to 200,000, which I appreciated that from a conservative nature, because again, one of our apartment complexes just went from 1,200 a door to 3,000 a door. So we just incurred an extra $500,000 unexpected expense in one of our apartment complexes, and that really crushed us. And I just don't want to experience that again. And so I appreciate the kind of conservative nature there. All right, everything else seemed relatively normal as I went down the line here. Now this gets to the point of when we're talking about interest rates and to the question of how do we structure these loans. And so what Reggie and I like to do, we'd like to just throw an extra tab as needed, and we start to just doing our own scratch calculations. And so what we determined, we said, okay, what is a realistic scenario that we think we can get this guy down to? What do we end up offering? Was it 40% or 35%, Reggie? Was it 35?
I said 40.
You said 40. Okay. So we were running our numbers at a 35% owner financing and an 80% LTV on the actual lending debt. And then in here, as I was looking at Reggie's numbers and talking to him, he had just talked to Oakworth, and Oakworth was saying it's 7.7% on the interest rate. And we were planning on offering 3% on the debt to the seller financing. So we were, for both of these, we were planning on the first mortgage, we're planning on 24 months of interest only payments from Oakworth, who's our primary lender. And on the second mortgage, we had planned on 5 months interest only payments. Was it just a 5-year balloon as well?
Yeah, 5 year.
With a 5-year balloon. So a term of 5 years and interest only for the entire term, basically, is what we were planning on paying for that. But knowing these numbers, this is when I started to highlight, this is why you guys want to back each other up if you're ever in a partnership. Trust but verify. Like I trust Reggie, I trust Josh, but I'm going to try to verify and back them up as much as I can. Because when I went into the numbers, I noticed the interest rate that we were underwriting to in the scenario was 7%. So I said, oh, let me highlight this to him and just make sure we're on the same page. It's actually 7.7. Seems like a minor thing, but I'm telling you, 0.1% can make a big difference in this world. So that's the first thing that highlighted as I was just trying to fix the numbers and back up my partner there. So from there, I jumped over to the summary tab. I said, all right, let's see what else we can find in the summary tab to back each other up here. So in the summary tab, it's going to actually reflect both mortgages. So this is where it actually reflects the scenario a little bit better than the scenario tab if you guys are ever in this situation. The summary tab or the scenario tab really only references the single mortgage, where the summary will show your first and second mortgage on the property. So with that being said, 20% mortgage here, then we see the second mortgage here, which he was showing only 30%. So this is another point where I highlighted, oh crap, like we would need to make sure we're referencing the right size mortgage here in the second mortgage. Otherwise, again, things are going to get jacked up. So I said, all right, let's plan on 35% on the mortgage there. All right. So from there, at the end of the day, what this is showing us, the other thing I wanted to fix here was the interest rate. So the interest rate was showing 4% when I knew we were planning on offering 3%. So I wanted to see from our underwriting where we stood. I understand what Reggie was doing. He was probably messing with the numbers to see how conservative we can be and what kind of our leash is with this negotiations we're planning on engaging with. But again, these are things that you can catch and help each other out from partners. So again, when I do this personally, what I do, I'll just kind of anything I change, I just kind of highlight in orange. So it's easy for me to kind of quickly review at the end of the day. And I'll kind of highlight here again, knowing that I changed the 7% on the previous tab. And whenever you're changing stuff here, guys, it's pretty easy to know which ones you can change and which ones you can't. If anything's referencing another cell, don't change that. Just go find that cell and change that, whatever cell's the actual input data. Otherwise, you're going to start to really jack stuff up. All right. So from there, again, I highlighted here, I'm like, dude, I don't understand the repairs and reserves. We're going to need to talk about this because this is literally $600,000 less than where we were before. But the nice thing is this is saying member capital needed to close. We're over budget by $167,000. So effectively what we have is $767,000 of closing that we can reference. So versus just a $600,000, assuming all these numbers are met. Any questions with that, guys? I don't want to go too in the weeds if I'm losing anyone for where we stand. Any questions with any of that?
So essentially, Matt, in this deal, you wouldn't be raising any investor capital, right? 100% finance.
This would be, yeah, over 100% finance. Exactly.
Yeah,
no investors would take part. This would be great on the Rolodex and help us out personally. but there would be no plans for it doesn't make sense to bring investors in the mix for this one.
So, I mean, is it like kind of a, ideal scenario in some ways because you can keep 100% of the equity?
Yeah. I mean, as an investor, 100%. I mean, you can look at any scenario as a good deal, bad deal, right? You've probably heard like the old Buddhist story. I love it, where the guy comes, the guy's son, he's a farmer, and the guy's son finds a horse, and everyone in town's like, "Oh, you're so blessed! Your son found a horse. You can work him in the farm." He's like, "Yeah, it's great. I love it. Got a horse." And so everyone's like super happy. It's so wonderful. He's like, "Yeah, we'll see. And then the son's working on the horse in the farm, and the son falls off and breaks his arm. And everyone's like, "Oh man, your son broke his arm. It's terrible. That's just the worst thing in the world." He's like, "We'll see. We'll see." And then all of a sudden, the army's coming to take all the kids for conscription for the army because they're having a war. And everyone's like, and they couldn't take his son because he's a broken arm. And everyone's like, "Oh, you're so blessed because your son broke his arm and he can't go to the war." So to answer your question, is this a good thing or a bad thing? It's a good thing for us personally as investors because we can really maximize depreciation. We can really enjoy the benefits of the tax really primarily, and hopefully just really great cash flow. The downside is I like investing with people because I'm helping them grow their wealth as well. And people are constantly reaching out to me looking for opportunities. And it's not like we're closing a deal a month, right? We're typically averaging 1 a quarter, 1.5 a year. So it's not like we're kicking these out super. So I do feel bad emotionally sometimes if we were to tackle this deal solo. But ultimately, Oliver, to your point, yeah, it's good for us. Yeah. All right. So let's continue. Any other questions as far as numbers or kind of scenario here, guys?
Can we talk about the insurance really quick?
Yeah. Any specific questions, or you want to just kind of jump into it?
You got 200,000 a year on your insurance, right?
Yeah.
And you got 90 units. So that comes down to $185 a month per door.
Yep.
If I'm doing my math right.
Yep. Sounds about right.
That's insane.
That's the exact word I would like to use. Yeah. Insurance is becoming almost criminal. Now, what I will say is my hope, we're trying to fight this battle we're trying to take advantage of this point for two fronts. One, it's a valid excuse to try to get a good opportunity, right? Or a good price. So either reduce the price because insurance rates are crazy and you can leverage that as a buyer saying, "Hey, I love it, but you're not underwriting this to a good deal. And so I need this price reduced." But also two, if we're underwriting to this insurance rate, the anticipation is the hope is that insurance rates will hopefully calm down. And then all of a sudden our NOI gets jacked up really, really nicely just because insurance rates finally calm down. And so it's kind of a win-win in that regard, but in the near term, it's a near-term pain. And the other way we're trying to fight it is through a master policy. So if you guys continue to grow your portfolios, which we hopefully will see plenty of units online amongst this group, we can then underwrite to an umbrella policy that we're all a part of, being what they call one large master policy. And then you can start to enjoy some benefits of one large master policy. That's what we're kind of working behind the scenes. A lot of investors are trying to work for master policies, but we've yet to find anyone successfully do it that I know of, that I know personally, I should say. But any other questions on that, Mike?
Yeah, besides it being insane, it's showing 22.9% on the expenses.
It's massive. It's absolutely massive. Yeah.
Yeah. I went back and looked at my rent roll. I got like 20 properties, different mix of different things. And my insurance expense is around 4%.
That's where it should be. It should be, I would say 5%, I think is a healthy insurance rate. Under 10 single digits is still good in my mind. But when you're referencing almost a quarter of your income just for insurance, just to give you an idea, the one property that we just increased $500,000, it's a 200 unit in that one. It's a 207 unit. And that one, the amount of increase that we just had, we can replace all of the roofs every year. And that's one of the biggest reasons you have. I mean, we have insurance for other liability and other stuff, but like the wind coverage alone, we're like, dude, we can replace these roofs every year. So if we have hurricane damage, it's just really, really asinine. So yeah, I agree. Crazy is the right word. I'm sure we can even find a more intense word. Reggie, any other thoughts on insurance?
Yeah, well, yeah. So this actually creates some opportunity. So, and I think this is pretty specific to the Gulf Coast because that's where a lot of these carriers are moving out of the markets. You know, the coastal premiums are going crazy. I think they're up across the board, but especially in these coastal markets where there's been lots of losses. So if you guys are anywhere near the Gulf Coast, I'd say within 50 miles of the coastline, like look around. There's probably some deals to be had because there's some distressed owners that bought with floating rate debt. Now their insurance has quadrupled and their property taxes have doubled because their properties have gone up in value. And there's probably not everybody's positioned to weather that storm. So it's going to create some opportunity. Just keep your eyes open for that kind of thing.
Reggie,
Hey, one more question.
Yeah, we'll go with Michael first, and then we'll jump over to Leo.
Sure.
sorry about that. I was asking you specifically, Reggie, because I know you're familiar with the area. And if you had anything in the coast in Alabama specifically, can you get those roofs fortified? Does that make a big difference? You know how they got the the fortification for the coastal area. I don't know if they do it in other states. I think maybe North Carolina or something, but
it does help. But I guess it's kind of inherent in the asset class that we focus on, like B's and C's. Most of the properties were built before 1995, and right now most insurance company they just won't look at anything older than that. And anything after that, that's when the rates just really skyrocket. And so, yeah, gold fortified would help, but we're talking A class, where you probably get the biggest bang for your buck. And honestly, I think they're still getting hammered because we talked about another deal in here, Mirabelle, that was, I think, down here in Gulf Shores, Class A, brand new build 2021. I just heard their insurance went up drastically. And it's a new build, and I'm sure they're gold fortified being down here. But
even our 207
yes.
unit, even our 207, you had just replaced the roofs on the 207 unit in anticipation of trying to get insurance discounts. So you can show your hurricane clips in the roofs. You can show like everything you want, like as far as that, and they'll try to get you discounts. But it's just gone haywire, man. Like honestly, the insurance situation is out of control right now.
yeah, I was meaning roofs specifically because of how they put them on, the fortification. And my personal house, the roof I got it fortified last year.
Mm-hmm.
Mine sure still doubled, but or at least that's what they quoted me. Anyways.
Yep. Leo, go ahead with your question, man.
Yeah. So on that note, you were mentioning that a lot of insurance carriers are increasing their premiums by a lot or like leaving the market. So just, based on like your sort of investment thesis of like the long-term hold, like perpetual and stuff, like, I mean, do you sort of take that into account? Like, hey, maybe these guys, like they see something, like they're leaving the market for a reason, like, should we be there either? That kind of question.
No, that's a 100% valid question. You look at something like New Orleans that got crushed by Hurricane Katrina, literally tried to be wiped off the face of the earth, and they just rebuilt it exactly where it was, saying, "Oh, these levees are better now." That is a 100% valid question. I still feel good about the growth of the market, which I think will just continue to drive scenarios that still lead to profitable investments in the multifamily space. But that is a valid concern. I think you can, like for instance, there are investors that won't invest in Mobile, where we are heavily invested. One of the ones that, if you guys are familiar with Jay Scott from Bigger Pockets, I went and spoke on his podcast, Drunk Real Estate, and afterwards we were talking, and I was talking about the master insurance policy, and there was some deal we were underwriting. I said, "Hey man, I would love to team up with you." So I just kind of brought him and say, "What were your thoughts on the Mobile market?" And he had his team underwrite. He's like, "Nah, we don't like the metrics. We don't like what's going on in Mobile. We're not going to invest there." And that's totally fine. I can tell, like, everyone's going to have their criteria that they need to meet, whether it be a macro criteria or a return criteria, whatever it happens to be. But Leo, you bring up a good point. Like that is 100% valid. If people are running away from an area, is that a reason you should consider maybe, if anything, reducing their portfolio in the area or mitigating elsewhere? But
that's fair.
Hasn't scared me enough yet, but it is a good point to ponder.
Good. Gotcha.
I have a quick question on the seller financing breakdown.
Yeah.
On that screen that you had. with
Yeah.
the,
I'll look.
so like the first scenario that you had, so again, at the 6.35 purchase price, right, you're getting a $5 million loan. And then the remainder, you're getting like you said, 2 million from the
Yep.
seller. Are you paying back to the seller that remainder of the purchase price?
So no, because the seller's giving us a note, but the seller's going to pay us via the money we give him, if that makes sense. Because let me think how would I describe this? Reggie, is there another way to describe it that might be more clear, that I'm not making sense, or Josh?
It always helps me to think about the title company as a third party, because the bank is putting something in the pot and the seller's leaving something in the pot, and you're taking that leftover. That makes sense. So the seller would end up with basically 60% of his sale price. We're financing 20% of it, and then, or I'm sorry, we're taking 20% to use as working capital to go towards capital improvements. Just keep the business running.
Because I'm trying to figure out, like, how do you come up with a purchase price? Because then I feel like the purchase price is really 7.2 or whatever. Like, how do you where's the cutoff? You understand my question, or it might be a little confusing?
I mean, that's just determined by fair market value. So like, what do we determine from? Does it?
You know what I mean? Because since you have, like, let's say 120% or whatever the percentage was, 115% LTV, like, how much goes towards the purchase price? Because that remainder of 1.2 in the purchase that the seller isn't getting,
Yeah.
I'm just a little confused, but
I'm trying to think of another way to describe this. So your big question is, why don't we shift in purchase price higher?
yeah, or I guess, how do you settle on a purchase price if if you're really getting a lot more?
Well, the purchase price is going to be determined by fair market value for what we think is a fair purchase price. Then that purchase price is going to dictate what the lender is willing to lend on it, which then determines how much additional capital we need to make our scenario work. Because it's not just about closing the deal for us. We do have a fairly decent amount of CapEx we plan on doing on the property as well. And so from a project perspective, it's not just closing on the deal as far from a capital position. Like, we need to understand closing on the deal, which is in the down payment plus the closing cost. Then we need that CapEx money as well as working capital and reserves. That's all the capital stack we need to kind of run the deal. And so when we're calculating a purchase price, one of the big variables is going to be, how much money can we get from the lender first, and then what's left over there for us to make our business plan executable. And so the lender's not going to, if the fair market value of this property is 6.35, if we were theoretically able to tell, hey, Mr. Seller, let's just make this price 7.5 million or 8.3 million, 2 million more. The lender, when they get the appraisal back, the appraisal is going to most likely going to say this thing's worth around 6.3 million. And so the most the lender is going to give us is a loan to value based on that appraised value. So we're running our numbers based on the most realistic scenario we can expect. If it appraises for 6.5 million, you might have an argument to say, hey, maybe it's worth it to just increase purchase price. That way we have more debt from the lender. It might be lower interest or whatever happened to be. Well, actually, low interest, that wouldn't help us out because we have higher interest rate from the lender. But we could maybe do a bit of a sensitivity analysis if for some reason it does appraise way higher. But more often than not, appraisals land right around where your purchase price is. And I say that because we've determined a purchase price based on what we think is a fair market value based on current operating as well as cap rates. Does that make sense? Did I walk it back a little bit better there?
Yeah, and Dan, just for another point of comparison, for it to work as a syndication using the perpetuity model, we would have had to have gotten it at what, 5.55? Was that the number?
Yeah.
Got it. Okay, yeah, it makes a little more sense. Thank you.
Okay. I feel like there's still a question mark over your head, so hopefully we'll clear it up as we go. All right. So where we stood, showed you the scratch work, showed you backing up Reggie as he kind of threw in the numbers, and then let's see if there are any other notes to bring up. before we jump in and show you the CapEx stuff. But I think that was it. And then from there, we started looking at the exit strategies. So with the exit strategies, this thing's going to look a little bit jacked up to you guys, because the way this works is you see your, what I like to do when anytime you're messing with something unique, I like to see a little bit more of the back office, what it looks like. So I go to the loans tab. If you guys ever mess around with this, this should reflect reality, because this is where all the numbers are going to be pulled from in the summary and exit strategy and all that stuff. So I see first mortgage positions is 5 million, which is what we expected. Beginning balance, we see interest only for the first 3 years, or for the first 2 years, and we start paying off the interest, the balance in year 3. That's why year 4 now it's a lower balance. So that everything kind of reflects what I expected to see there. And then I see the second mortgage here with balance being the same across the board, interest rate. So all of this is shows about right to me. So what this shows me, you know, in year 5, which is our current refinance year, again, longer than our normal perpetuity model, we see that we have a total of $7 million in debt, 7,019,000. So I'll let you just back myself up. So I'll go back to the exit strategy tab here, and they're showing a repayment outstanding balance of 6.8 million in at the end of year 5, which would be the following year. So that is basically accurate, what we like to see. So what I want to do here is now when we're messing with the numbers, we see, okay, what is the cap rate we expect? 7% seems good to me. 70% loan to value. That's a conservative nature to me. I think we could probably push that to 75 or 80 if we wanted to, but again, there's not investors in the mix right here. So I just want to see a realistic scenario for what we can cash out, or when we can pay off all of our debt, if you will. Get a 5% interest rate on the refi. Doesn't really matter. That's more of a cash flow post refi right now. And then we have a refinance loan amount. So this is the loan amount that I care about to make sure we pay this off. We're assuming a 2.5% interest on 2.5%, 2.5 points for closing costs, basically. And so this is our loan balance for the loan. Sorry, that's repay outstanding. So this is our loan balance we need to repay. And so what this is showing here is we are effectively, we're breaking even, $167,000 in the positive now for this one. So if I go to year 4 now,
well, that's saying return of member capital, because it said we had negative 167 that we were getting paid at closing, and so that's this analyzer trying to return that. Yeah. So what this is showing here is $127,000. We are making $127,000 in this refinance. With this $167,000 is the return. This is why it gets jacked up, because there's a negative number here. So that you're going to see 100% here regardless. What this is showing here is negative 167,000, and this comes from the summary tab right here, this number. So total member capital needed to close the deal is this 167,000. So we see in year 5, we're able to cash out 127 grand if we hit our numbers. Go to year 4, we're in the hole 253,000 ish, but we still have that 167,000. So, you know, it's kind of year 4, year 5 ish kind of works in that range. So it makes it start to make me feel pretty good about the scenario. Not my normal 2 to 3 year cycle that I'd like to see for a perpetuity model. But again, I'm willing to personally accept a little bit more risk and accept a refinance in the 4 to 5 year range rather than the 2 to 3 year range. All right. So that's how we hit our numbers, guys. And that's how we kind of ran them from there. I double checked, you know, make sure wasn't anything wonky, but everything was basically the same for the pro forma that we reviewed last week. And that's where we stood. And so that's how we submitted our offer. And I was hoping to give you positive news like, hey, we got the offer accepted, but we'll see where we stand on Monday. We'll keep you guys apprised of our situation. But if there are any questions about the numbers, I definitely want to make sure this is clear in your guys' mind, because this is a scenario I would love for everyone to get involved with, of, you know, buying a 90 unit apartment complex with no money out of pocket.
I have a question on that, on the negative, you know, the negative 167.
Sure.
So are you, maybe I missed it, but are you keeping it like that, or is that going to end up being 0?
That's money that we get paid at the closing table.
Yeah. So this is basically, we're going to have an additional, if I wanted to just change this, I can make this $167,000 more. So I can go to a scenario tab.
That's just like working capital.
Yeah. So if I go 767 ish, and I go back to the scenario tab, summary tab, like we're looking at basically breaking even there, right? So this is assuming we we have roughly 750 grand in capital capex and reserves.
So why would you want to take extra that I guess in theory you wouldn't need, like just paying interest on it?
Well, that leads us, it's a great segue to why we have this extra money is for the capex and reserves. And so Reggie, where did you have that breakdown? Was that Slack?
I dropped it in Slack.
I mean, is your mindset like, we may as well take extra money at a low 4% rate? Because why not? Just to be safe.
Well, one, yeah, but my big question was at this point. So we you guys understand the numbers, hopefully at this point. And if you have any questions, I'm happy to clear them up. But my biggest question leaving this to Reggie was, why did we reduce our $1.2 million original reserves and working capital down to now to $600,000? And so I said, let's dive deeper into the capex. And so let me pull this up. I'm just going to bring this into, I'll just share our actual Slack channel over here. All right. So I said, I think we need to map out the capex a bit more to be comfortable, but yes, I think we could work. So this is our internal dialogue between us, just to give you guys an idea. So I said, hey, how many units need to be flipped? How many HVACs need to be replaced? And what buildings need exterior paint? And do we all the roofs are new? I just want to confirm. Do we need to resurface any parking lots? Anything needed to be restriped? Any plumbing concerns? Any other big ticket items? So the question is like, what do we know that needs to be addressed here? And so we need to build hopefully a conservative number that we think is realistic to get everything done. And so this is what Reggie's response was. Hey, about 60 of the units require a full turn. We're assuming a full turn to be $10,000 a door. How do we know that? It's just experience, I guess. I mean, Reggie, any other way to help to guidance for offering what the cost of a full turn is?
We've turned a lot of units in the past 2 years.
Yeah.
And so we've just kind of, this is tribal knowledge, and it's I would say it's geography specific too, because that number would probably be double maybe on the West Coast. I don't know, but it probably does depend on where you are, because labor and materials are going to be different. But that applies to Gulf Coast, I would say, from like Pensacola to Biloxi, kind of along the I-10 corridor.
Yeah. And so I would just say you need to just engage. If this is your first deal in a new area, we would have to engage contractors. We'd have to engage property managers to really get a good idea what a full turn is. We just turned, a couple right in Mobile. Were really heavy turns, and they were at $12,000 a door, I think is what we paid for those ones. So just give you an idea there. Okay. So from there, 30% of the HVAC units will need to be replaced in the next 5 years. I knew some had been replaced, but we're assuming 30% needs to be replaced. And so we got a number roughly for that. 3 buildings need exterior paint. And so exterior paint, that's not a cheap thing to do for these buildings. We've done that in Mobile as well. And when you change the exterior of a building, you really do change just the feel of the building in general, and you can command some nicer rents, especially if it's a big shift in the way it looks. All roofs are newer, so not a concern there. Copper wiring, which is great. So we've dealt with some annoying rewires that we in some of our properties as well. So we know that's not one less headache. Plumbing is PVC and PEX, so no poly B, which is also good. And then parking lots, so some are good, some need resurface. So this was Reggie's bar napkin math, who said, okay, we need about $540,000 for the renos. We need $130,000 for the HVACs, assuming 5,000 HVAC, and exterior paint called about $75,000 total for paint, and parking lots are 50,000. Add all that up, I'm assuming it's roughly $800,000. I didn't actually add it up for you, Reggie. Let's see, 540 plus 135 plus 75.
Please be right.
50. Yeah, there we go. Now I normally like to say, okay, how far off are we going to go with these numbers? If we throw in another 25%, which I guess should have been easy math, we're basically looking at roughly $1 million in capex. Now, this is just a capex point, right? This is where we eventually backed into where we were before, 1.2 million. So the question now is, we need working capital, we can't just say, hey, here's a check for 1 million, go fix everything, because then we're broke, right? We need to make sure we have working capital to go along, and reserves on top of that. And so the question now is, do we think we can eke along and make this happen? I think the answer is yes. I don't think these The paint doesn't need to happen right away. The renos are going to happen, you know, as we flow along. And so we do need to get a little bit more granular with our CapEx, but this kind of gives you a little bit idea of how we started breaking down the math to get to back into the number. So in the end, $800,000 is still more than what we anticipated there. And so that's why we went back to what Reggie had said he offered. Reggie ended up offering actually 40% on the deal, which is going to give us around a little over $1 million in additional money that we can spend in CapEx and reserves. So this is the round out way to show you what the final offer was and why, guys, and where we stood with it. Any questions on any of that? I want to make sure this is all clear on the scenario and the numbers.
Just a quick question, and I'm asking a lot of questions.
No, please do.
So on that note, are you still going to keep it at 0, or you're going to keep it at a negative number? It does not matter. Is it all the same?
On the
like
note,
on your underwriting, like in your underwriting, are you going to keep it at, like, for example, negative 316, or are you going to make the repairs and reserves, you know, whatever the total was there?
I mean, it's the same. It doesn't really matter. So I can change this to whatever it is, probably around 1.1 million. Do I add an extra 0? No, let me see. So there you go. So yeah, roughly about 1.1 million. So no, I don't anticipate. I can change it. Changing that cell doesn't mean anything to me personally. As long as you understand what the numbers mean, that's what the most important thing is.
I was just curious if it actually made a difference. Like
No, that's not going to change anything in the numbers here.
Got it.
Hey Matt,
Good.
Sorry, can you remind me the first position loan? Was it a 5-year loan, interest only, or 10 years, or what was it?
So the plan for this was 2 years interest only, with a 5-year balloon, 7-year balloon. What was the plan for the balloon for that one, roughly, Reggie?
5 years typical for Oakworth.
Yeah.
Got it. And for the second position loan, it was also a 5-year balloon?
That was 5 years. It was a 5-year term, interest only for 5 years. So it was interest only the entire time. Yeah.
Okay. So I guess you have to be careful to be sure that at year 5 you can remember those both loans, right? Especially if you're capped at 5 years on both loans.
Every one of my loans, I'm going to try to work in some extensions that we can work in there. Whether we need to pay for the extensions or the extension are based off appraised value, whatever it happens to be, we'll always try to work in at least 2 optional extensions. So we'll get 5-year hits. Even if we need to pay 1% per loan or whatever the percentage is, I'd like to be able to extend a year. And then if we hit another year, I'd like to be able to extend another year as well. So that's part of negotiations. We would like to work in effectively a 7-year loan, but really a 5-year term is what it is.
Got it. Because if you didn't have that, it would be super risky, right? Because it seems you're already tight on the refi.
You're putting yourself in a square corner for sure. Yeah, absolutely. Absolutely.
Okay. And then, so how would you present that to a seller, basically? Like, what would be your pitch to present this to a seller as far as from a tax perspective, or like what would be your pitch, basically?
I'll talk big picture, then I'll hand it to Reggie for how he actually did it. From a tax perspective, this is beneficial to a seller who's looking at some serious capital gains. I know we've talked in the past about installment sales, which is what this is to a seller. And installment sales don't remove the capital gains, but they extend the capital gains down the road because the seller doesn't actually realize that profit until effectively 5 years down the road. And so from his perspective, it's comforting. The other thing is, depending on where the seller is, this seller is an older dude. His partners are older as well. It's just kind of consistent cash flow for people who just kind of want to sit back and take that true mailbox money. And so for someone who's grinded his whole life, I think he's a politician. He's on Wikipedia. You can look him up. It's could be a benefit from them just to be like, all right, man, here's your steady paycheck. I know you're probably already got multiple paychecks coming in, but here's just one more so you can enjoy life a little bit more. But yeah, those are the 2 big pitches. But I'll hand it to Reggie to see exactly how you kind of worded or any other additional benefits you kind of touted.
Well, first I went to the broker and kind of asked his advice, just to kind of test the waters. Hey, do you think Jim would be open to this? You know, what kind of terms do you think he would accept? Is it possible? And he said, well, I know that they don't have a loan on the property. It's not collateralized against anything. So that's, that could work. He said, there are multiple partners and some of them are older. So I don't know, it could go either way. And so what we kind of agreed to do is all 3 get on the phone, and I would only broach the owner financing if I found a door. And so we got to talking about the insurance, and I kind of laid out the the climate there, and he understood, and he's like, well, what should we do about it? I said, well, I know you're probably not, wanting to budge on price, and I kind of feel bad asking you to retrade it on anyway, even though we're not under contract. I said, but for us, and I was very transparent with him. I said, and I don't always do this, but again, I was kind of shooting from the hip. I just had this gut feeling. And so I just said, look, we syndicate these deals. We raise private investment capital. We have to pay them a return. And so in these types of deals, like, to you, they might look like a middleman. So if there were an owner financing component there and we didn't have to raise the capital, we could pay the purchase price. And he just got silent for a second. And he was like, well, I think I can convince two of the partners to hold some paper, and we can just pay off the others with the funds that we get. And then after that, he said, look, send me your terms, send me the specific numbers that you're proposing. I'll run it by the partners and we'll get back to you. He said, I'm not saying we'll accept it, but we'll certainly entertain it. And so all in all, it was I say on this side of good. Like I felt good when I left the conversation. So we'll see. It's the guy, I got to feel like he's the type that's done some wheeling and dealing in his day. And he's also an attorney too. And so he's familiar with, idiosyncrasies like this. And so, yeah, I just kind of relied on my gut a little bit to take the opportunity to present it to him, and he didn't shoot me down.
Great.
Reggie, if you don't mind me, I used to work for a syndicator down in South Florida, and the way he used to mention it to sellers is basically, since we're all doing value add, if you do seller financing with them, the property is the collateral if you default on the loan. So we always mentioned that, if we, God forbid, if we did default, you're getting a prettier asset with all of our money into it back for free, plus all the money that we've already paid you. It just kind of makes it sound sweeter to them that, we're throwing money into their asset and they're getting paid for it while we're doing it, if we defaulted.
Yeah, I do like that. I haven't thought about that angle.
Yeah, absolutely. I mean, it's a secured asset, right? It's nice. You're not just throwing your money in the stock market, and in this scenario, because they're second position, I wouldn't lean on that one too much. But a pure seller finance one, 100%, absolutely. That's a great leverage tool to use. What else, guys? Any other questions on the scenario where we stand?
I got a question. Kind of, I hate to circle back to the seller financing game, but I guess it's more of like a clarifying statement, just so I fully understand.
Yeah.
So the lender is providing 80% of the asking price.
Mm-hmm.
The seller financing is covering the other 20%, which would normally be covered by investors, correct?
Correct.
So, but then Reggie added in the seller financing to 40%, which also covers the CapEx, reserves, and working capital. And so that's why the overall purchase price is technically in the 7 million range. Is that correct?
No, the purchase price remains the same. So.
Okay, yeah. So okay. So the purchase price was still 6 point whatever, but where did that? I'm thinking of the 7.2.
Let me just make these numbers exact. That might help you guys out. So we got 16,000. What is this equals this? This might clear it up for you guys. What is this number? Copy that number. Let's go here. Let's. Copy. What the freak is going on? Undo. All right, 1083.93. Let me just change that. 1083.93.
Yeah. So okay. So the acquisition cost is what I was looking at. The 7 point.
All right. So first thing I'll highlight before I jump in, I'm going to go over the seller financing one more time. You will see I'll say the single capital benefit that helps us as investors if you don't bring in syndicators is the fact that we are not paying ourselves an asset management fee. We are not taking an acquisition fee. There's no additional fees that we would raise to pay ourselves for doing the work for all these other investors. So we are going to make money, don't get me wrong, but we're not, this is less fees to consider in the grand scheme of things, or ongoing, 2% per quarter that we're paying ourselves as asset managers. We're just going to be paying ourselves purely from the cash flow. All right. So with that being said, let me do this. All right. So purchase price here remains 6.35 million regardless. Now from there, what we care about is our two loans. We have two loans, a loan for 5 million and a loan for 2.54 million in this scenario. We're going to pay at closing. We're going to, on the closing document, it's going to show 6.35 million in the purchase price. From there, it is from the seller buyer scenario. Let me see if we can do this. You guys have seen an Alta before, right? Let's see the best way to break this down. Seller, buyer. We're each going to show the purchase price. One's going to be a debit and one's going to be a credit, right? That's how we're showing this in an Alta. Trying to think of a one I can just pull up quickly to show you guys. From here, roughly 5 million is going to pull for the seller is going to be shown. We're going to show 5 million on our side as a note. 5 million. No, can you turn all these things? This might make sense here. All right, we got this. 5 million as a note, and then the what you're going to see on top of that, you're going to see a 2.5 million for easy math. Not 25 million. So you're going to see this as from the lender is going to give us this on our Alta, and then the seller note is going to show this. So you're going to see lender note and seller note on the Alta at closing. And so at the bottom line of the closing, you're going to see it will say, like, normally it says amount due from buyer is what it normally says at the bottom, and amount due to seller is what it normally says on both sides, right? When at the bottom of our note, it's going to say not due from buyer, it's going to say amount due to buyer. We're actually going to get a check at closing, and that check's going to be roughly 1,083,000 is going to be roughly what that check's going to be. And on the seller side, because he's getting paid $5 million, and I'm removing a lot of the additional cost here, and because he's given us a $2.5 million note, wow, that'd be great if you have 250 million. One of these actually negate each other, right? So this is a negative for him. So it's a negative 2.5 million, but it's positive 5 million. So what he's going to kind of net at the end of the deal is going to be amount due to the seller is going to be the purchase price minus that's going to be the purchase price minus the 5 million plus, I'm getting these all jacked up. It's going to be wrong. Yeah, so whatever. I think I'm subtracted where I should add it. Regardless, they're gonna get paid roughly $1 million at the end of the day. Does that make sense? Because it actually is going to be more than that. It's effectively the difference. So he's trying to see how to do this. We are paying him 5 million, but out of that 5 million, he's giving us a note for 2.5 million. So he's not realizing this. So I mean, he's going to be showing roughly the difference of that, we'll say. So it's roughly 2.5 million is that what they're going to get paid at the end of the day.
Yeah, and then that 2.5 million will cover the CapEx, the reserves, the working capital, all that stuff as well.
Yeah, it's not going to be the way we typically like to do it and having it all up front, but we're close enough to that 1.2 million that I'm comfortable eking it out from there. Again, I'm personally accepting a little more risk than I wouldn't have otherwise with investors in the mix.
Right, got it.
Is that clear? I know it can be confusing.
It is to me.
I just want to make sure on the buyer side, this is what you guys need to understand, right? So like your Alta, you're going to see the purchase price. You're buying this for 6 million. Of that, 5 million is coming to be debt from the lender that's being paid, and 2.5 million is coming from the seller. So we're going to get that difference between these. So this is really what I mean. I guess the summaries. We're paying 6.35 million, but we're getting a loan for 5 million. We're getting a loan for 2.5 million. I think you guys understand that in general, in that concept. On the seller side, they are getting paid 635,000. I actually don't see that. That's really what this is where I jacked up. Sorry, guys. They don't see the $5 million note. What they see, they're getting paid 635,000. But of that 6.35 million. Of that 6.35 million, this is what the actual should be. It's going to be their purchase price. Damn it. It's going to be their purchase price minus the note that they're giving us. So that's what they're going to realize at closing. Again, there's closing costs involved here. I'm looking at the big variables at play, but this is really what actually is going to be reflected. So they're making 6.35 million. That's what we're buying it for. But of that 6.35 million, they're going to give us 2.5 million of it.
Yeah, I think I just really wanted to understand more of how you use both a lender and seller financing without the need for investors involved. So I think I got it pretty clear now.
Yeah. So because of this note, this is why this whole seller finance note here. This is what's allowing this to happen, because he's paying us 2.5 million at closing from the proceeds that we're giving him effectively. And so ultimately, like we don't need to pay as much, right? Because he's given us a note for it.
Yep, got it.
I want to make sure it's clear. I just feel like it's not clear. If you guys got questions, please ask them.
So in the ideal world, you would have asked him to finance the whole thing, right? Maybe you don't even need a first position loan.
In a perfect world, exactly what Dylan was saying. That's exactly what we want. We want 100%, or well, you couldn't in a perfect scenario. Most sellers are not going to pay you more than what you're paying it for. So like if we had seller financing here, we would have to come up with that CapEx out of pocket, because most sellers aren't going to pay you money to buy their property. That's unlikely. They want to see money, some sort of money at closing. And so this is actually almost a better scenario to where we got it, the CapEx covered, closing costs covered, and the purchase price.
Yeah, that's great, because you have CapEx. If you were just buying a property without CapEx, then it would have been ideal to have 100% financing from the seller and without first position.
Like when I bought my RV park, I bought it 100%. It wasn't 100% seller finance. It was a 25% down payment, but I worked 4% loan, and it's just super simple. There's no appraisals to deal with. It's just like a very streamlined process. It's the biggest, honestly, one of the big benefits of working directly with sellers and seller financing is you don't have to talk to a damn lender. As much as I love Chase and Oakworth, and they've saved our bacon, they're awesome. They still require a lot of paperwork. When you're dealing with sellers financing, it's where do you send the check? And that's pretty much it. They sometimes might do a credit check on you, maybe. But all of the seller financing I've done, I've never had any of that. It's literally just, hey, agree to this note, sign here. I owe you this much. That's it. Tell me where to send the check. Super streamlined. No surveys needed, no appraisals needed, none of that stuff.
You're also able to negotiate interest rates and down payments and all that.
Yeah.
In terms.
I mean, you could negotiate a 0% interest loan. You will potentially deal with what we talked about this last week. It's or a couple weeks ago. What's the word I'm talking about? It's where they charge you for the ghost interest. It just escaped me. But effectively, the government kind of sees through that sometimes if you're paying someone 0% interest. So the government could effectively tax them for the interest that they're not earning. But that interest is super low. It's like 1% or something. But anyways, I wouldn't let that stop me getting a 0% interest loan.
That's actually been something that we've used to negotiate is if they're willing to do seller financing, then we'll actually offer more than what they're asking if they can lower the interest rate a little bit more, so it makes it more attractive to them.
Yeah, I keep it simple, right? You can either offer terms, I can give you terms, or I can give you price, but I can't give you both. So if you want the price, I need the terms. If you want the terms, I need the price. Like if you want this 10% interest loan, sure, I'll give it to you, but I really need you to drop on price to make that make sense. But if you want that price, I need you to drop an interest rate or whatever has to be balloon period or like whatever I need to make sense for the deal.
Seems
And
like we've blown a lot of minds tonight.
Most lenders would be okay with having this second position seller financing, or not really.
It really depends. Having that relationship is going to be key. I don't think a lot of big lenders are going to do this. You go to like your conventional mortgage with Fannie Mae, Freddie Mac. I think you're going to struggle closing a deal like this. I say that anecdotally. I've not tried with agency debt. However, I know they're much more streamlined with their requirements, and I could see that being a requirement where they don't allow that. So you would probably have to close with more of a Morby method if you had this scenario where the seller's willing to do that. And a Morby method is the same thing. You just got to come up with that temporary cash to close, and then you're normal after that.
Makes sense.
Well, we had something else we were going to cover, but obviously we're out of time. So we'll just cover that in the next Thursday. We get back together.
What was the other thing? The renovation estimator?
Yeah. Just talk about how to actually come up with CapEx, because someone asked it literally tonight, and then I've gotten the question a ton, and some people email us after the fact and call us after the fact and ask about it. Some of it's tribal knowledge, but Reggie did his best to put something together for you guys that's more streamline it or automate the ability to come up with those more exacto estimates for CapEx when you're doing your underwriting.
Yeah, little expense, CapEx tool basically.
Cool. All right, everybody. We finished 60 seconds short. How about that? This has definitely been a fantastic meeting, I think, today. And a lot of questions, a lot of engagement, a lot of interaction. Seems like a lot of you actually got a lot out of this, being like, oh, that's really cool. I didn't even think about that. And then trying to figure out exactly how it works. So I'll upload the recording of this call. And Matt, should we upload the underwriting that you just did too?
Yeah, I'm just going to save it as is, so you guys can see the same notes in scratch work. I'll upload that right now. I'll throw that in Slack.
And I'll put it in the next basically section of the advanced underwriting for anyone looking for it. So last thing I'll say, October 6th and 7th. For any of you that don't remember what we talked about earlier, or if you joined later, October 6th and 7th is going to be the dates for our in-person meetup this year.
Yeah, if you guys have any questions at all, Oliver, I know you said it's your wife's birthday. You can make her wife's birthday trip a business trip and tax-free, brother. Not tax-free, but
yeah. I'm bummed, but no, I can't, because we're doing a bus party. Like, we're renting a bus, and we have like 50 people gonna party in that bus. It cruises along San Francisco, and it just also stops. Like, it stops like every 30 minutes, and it stops on the beach. I mean, it's pretty cool concept. So unfortunately, it's just on that weekend. So can't bring the bus to Mobile, unfortunately.
I don't think you want to bring the bus.
I wouldn't pass it up, and yeah, that's going to be fun. But we'll get you next time for sure. Well, next time we're going to plan further ahead. We just didn't want to delay until like next year to try to plan this, guys. We wanted to get going and getting some meetups in person as much as we could.
Whoop whoop. We'll release some more details too, and then when we actually book something, we'll let everyone know whether or not we've decided to book the house or whether or not we've decided to book some kind of like hotel conference room, because regardless of what we do, that'll determine whether or not you can basically come and bunk, like get one of the actual beds in the house, or whether or not you'll have to get like your own hotel room or something. But anyway, we'll keep everyone informed of all that. That's all I got.
Right on. Thanks, guys.
Appreciate you guys. Have a great night.
All right.
Have a good night, guys.
Have a good one.